Some people pay no tax, while others pay tens of thousands of dollars. Why is that? Did you know that many homeowners and investors pay unnecessary taxes simply because they don't know about this rule? This is the 6-year rule, also called the absence rule, which can save you thousands, even hundreds of thousands of dollars in tax. So, what exactly is the 6-year rule? Simply put, it is a regulation that allows you to avoid capital gains tax. Normally, when you sell the home you actually lived in, it is exempt from tax. But even after you move out, if certain conditions are met, the property can still be considered your main residence for up to 6 years. This means that even if you rented it out, it can still be treated as your home and you can reduce tax. So, what are the conditions? Remember these 3. First, it must have been a property you actually lived in. Second, you cannot choose another home as your main residence at the same time. Third, if you rented the property, it can be recognized for up to 6 years. Here is the important point. The 6-year opportunity is not limited to once. If you move back in and live there again, the count resets, and you can use another fresh 6 years. However, partial rental or business use is an exception. If only part of the house was rented, tax will still apply. Also, if you are a non-resident at the time of sale, in most cases, the exemption does not apply. That is why being a resident under Australian tax law is a very important point. For those who still find this complicated, here is a simple example. Mr. Kim lived in a Sydney apartment for 3 years, then left for an overseas assignment. He rented out the property and sold it 5 years later. In this case, because it was within 6 years, the entire capital gains tax is exempt. But if he sold it 7 years later, it would be exempt for the first 6 years, but the last 1 year would be taxable. What if he came back? Suppose he rented it for 4 years, then returned and lived there for 2 years, then left again and rented it out for 3 more years before selling. Since he actually lived there again in the middle, the 6 years reset. Therefore, the entire period would be fully tax exempt. But in practice, there are important things to be careful about. You must keep a record of the market value when the property is first rented out, because it becomes the basis for future tax calculations. Also, you must keep proof of the dates you left and returned. Finally, you must check if you are considered a tax resident of Australia at the time of sale. To summarize, if rented, up to 6 years. If left vacant, indefinite. If you move back in, the 6 years reset. This is the core of the 6-year rule. By using this rule well, you can save thousands, even hundreds of thousands of dollars in tax. If you are wondering whether your situation qualifies, contact Better Life Property Group. Thank you.